Throughout our working years, we attempt to accumulate as many eggs as possible into our retirement nest. Unfortunately, many people spend their energy focused on how to accumulate the large retirement nest egg without giving any thought to where their retirement assets should be invested. While accumulating your desired amount in retirement assets is important, we feel that it's just as important to have your money in assets that represent the level of risk or safety that you want. One of the easiest ways to determine where you should have your retirement assets allocated is to use a color system for your money. Our firm has put together a simple way for you to group your retirement assets into red, yellow, and green money. The world is different today, and therefore, retirement is different today than it was for your parents or your grandparents. Even in the last 10 or 20 years, the realities that retirees face have changed. Medical advances help people live longer, healthier lives. Technology helps bridge the hundreds or thousands of miles between families and friends. And because of the same technology, you now have more information available to you than ever before. So what is this information telling you? Specifically, what it is telling you about the financial challenges you may face in retirement. For instance, is the stock market really scarier now than it was 20 years ago? Are financial decisions more difficult, or does it just seem that way? Hope so money. This is the volatility index, or VIX for short. You may never have heard of the VIX before, and that's not surprising. It's kind of a specialized index. It measures how much the stock market is expected to move up or down over the next 30-day period. In other words, is the stock market expected to be more volatile or less volatile over time? Because the VIX measures market volatility, it is also sometimes referred to as the fear index. You could see that back in the mid-90s, the VIX didn't seem to have the wide swings that it has more recently. On the other hand, around 2000 and again in 2008, it seems that the chart really spikes. So, according to this chart, if you place money in the market back in the 90s, there might be a good year or a bad year, but on the whole, the VIX would say that the fear index was lower then. We refer to money you have at risk in the market as hope so money. This is money that you hope will be available to you when you need it most. It doesn't have any guaranteed minimums, but of course, it doesn't have any limits on the upside. For the sake of simplicity, we also use the color red for hope so money. The color red is almost an international symbol for danger or be careful. For our purposes, the color red doesn't necessarily mean stay away, but instead, you might think of it as proceed with caution. Much like a red stop sign, when you are reviewing your hope so money, you should always take a moment, look around, and assess your situation before you proceed. So that's an introduction to hope so money, or red money. But it's not just market volatility that has changed in the last 20 years. Safer money alternatives have also changed. No so money. This is a graph of change in the 10-year Treasury rates over the same time period that we looked at for the VIX. Early in 1990, the 10-year Treasury was around 8%. The 10-year Treasury is a pretty good measure for tracking the relative changes in fixed rates or financial instruments that credit a fixed interest rate. In this context, the 10-year Treasury is also a good proxy for no-so money. This is money that you reasonably expect to know what is going to be worth in the future, as opposed to money that you hope will be there. With no-so money, you know it will be there. And looking at the graph of the 10-year Treasury, you could see its ups and downs are much less severe. Money that you have in a fixed rate product is much more predictable. So, how has no-so money changed over time? For instance, early in 1990, the average one-year CD rate was just a bit under 9%, and the prime lending rate was just a bit over 10%. But since 1990, while it hasn't had as much volatility, it's slowly been creeping downward. If you have money in fixed rate products, your opportunity for growth has also been diminishing. Retirement is different today. Let's examine using hope so money and no so money. How retirement is different for you today than it was for previous generations. So, in the early 90s, if you had money you wanted to set aside for the future, you could either use hope so money or no so money, or a combination of both. Relatively speaking, The market was less volatile and perhaps more predictable, and fixed rates were higher. If you chose to save into red money or green money, the difference between the experience might not be as different as it is today. The likelihood of making a big mistake was less when these two lines were close together. Today, the VIX paints a picture of a more volatile market, and fixed rates are much lower. The gap between red money and green money is much wider. If you are a retiree who is looking for a rate of return that can grow your money and still feel safe, the decision-making process is much more difficult. The choices that your parents faced were, perhaps, more simple and more straightforward. Today, however, these traditional choices might feel more perilous. Understanding which instruments might leave your money at risk and which are safe is more important than ever. And it is more important than ever to understand exactly where your money is. Do you know how much of your retirement nest egg is in hope-so money and how much is in no-so options? Do you know how much is in red money and how much is in green money? Two types of green money, light green and dark green. Green money actually comes in two varieties, light green and dark green. Dark green money is probably the traditional type of safe money you might first think of. Dark green money receives a fixed interest rate, and you know exactly how much you will have at a given point in time. You know what the minimum value will be, and you also know what the maximum it might be. As you might imagine, when you remove the variables and look for specific or even guaranteed rates of return, some of the potential upside growth is diminished. Dark green money is the safest, but it also provides less growth potential. Examples of dark green money would be certificates of deposit or a multi-year guarantee annuity that has a fixed rate guaranteed for the length of the contract. Another example of dark green money might be a pension program or even Social Security. As fixed rates have fallen, a new type of green money has emerged, light green. Light green money still has a guaranteed minimum value, but it also has the possibility for greater growth. You don't always know exactly what the interest rate you will be credited every year, but as a trade-off, there is usually more potential for growth. An example of light green money would be a fixed index annuity. Each year there are a minimum guarantee of some sort. Either the account value won't be less than it was the year before, or less than what you deposited, or some variation, depending on the specifics of the contract. The amount that your fixed indexed annuity might grow that year might be something of an unknown. It could be tied to the return of an index or multiple indices. With light green money, you will always know what the minimums are, but you might not know what the upside is. Because of this, there is usually a greater opportunity for growth. Yellow money. There is one color of money that we haven't discussed yet, and that is yellow money. Yellow money is similar to red money in that there isn't a guaranteed minimum, but there also isn't a cap on your upside potential. The financial tools that might be considered red money or yellow money are the same. The difference is that yellow money is being actively managed by a professional. Professional management means that there is a third party who is actively reviewing and maintaining the investments. Because there is active management, what was once a red money item is now yellow. Typically, professional management carries with it some significant advantage over non-managed assets. Professional management of your money is similar to professional management of any other item that is dangerous in the hands of an amateur. Like a gun, a race car, or a fighter jet, these items are dangerous if you're not trained to use them. In trained hands, red money options become yellow money, a powerful tool with a specific purpose. When you review your complimentary Color of Money report, you will have a chance to look at your red money and consider the advantages of professional portfolio management. Does it make sense to have a trained professional watching one of your most important assets? The color of your money, red, yellow, or green, light green or dark green, it's really all up to you and what makes you feel comfortable with your financial future. But before you can decide what makes the most sense, you need to know what you have. You need to know what you own and how it all works together. The Color of Money report provides you with a fresh perspective on your finances. For many of my clients, it is the first time they have ever looked at their entire financial picture and been able to see how much was in green money options and how much was at risk. I make this report available as a complimentary service for those who are members of this website. It is an extremely valuable tool to make sure that your financial future is appropriately based on no-so money and not just hope-so money. Armed with the information in the complimentary Color of Money report, you can begin making educated decisions for a retirement reality that is different for your generation than any that has come before.